Welcome to our Intermediate Trading Concepts series. Today, we're going to delve into the world of swing trading. This trading style is popular among traders who seek to capitalize on short to medium-term market movements. Let's explore the fundamentals of swing trading and how it can be implemented effectively. Swing trading involves holding positions for several days to weeks, aiming to profit from expected upward or downward price moves. It's a strategy that sits between the rapid pace of day trading and the long-term approach of buy-and-hold investing. The essence of swing trading is to capture significant price moves within a medium time frame. Swing traders utilize technical analysis to identify potential price trends and make decisions about entry and exit points. For example, a trader might identify a stock that is on an upward trend, buy during a minor pullback, and sell when the price reaches a predetermined target. Technical analysis is pivotal in swing trading. Tools like moving averages, relative strength index, RSI, and moving average convergence divergence, MACD, help traders assess market momentum and identify potential entry and exit points. For instance, a swing trader might use a combination of a 50-day moving average and RSI to determine the strength of a trend and the optimal time to enter a trade. Risk management is crucial in swing trading. This includes setting stop-loss orders to minimize potential losses and using proper position sizing to control the exposure of each trade. For example, a trader might set a stop-loss order 5% below the purchase price to limit potential losses while using position sizing to ensure no single trade risks more than 2% of the total portfolio. Psychological factors, such as discipline and patience, play a significant role in swing trading. Successful swing traders maintain discipline to follow their trading plan and have the patience to wait for the right trading opportunities. A disciplined swing trader avoids impulsive decisions, sticking to their strategy even amidst market volatility. In conclusion, swing trading is a dynamic trading strategy that requires a solid understanding of technical analysis, risk management, and a disciplined mindset. It offers the potential for significant profits, but also requires careful planning and execution. Exciting topics await in our Intermediate Trading Concepts series. Join us as we deepen your insights into the financial markets. Thank you for watching. Don't forget to subscribe to our channel and hit the bell icon so you never miss an update.